Picture 3 doors in a bright hallway. Above the first, LLC. Above the second, S-Corp. Above the third, C-Corp. Behind each door is a different tax life. How you pay yourself, what you keep after tax, how much paperwork you carry, and how fast an investor will call you back. Start with the LLC, because it's the friendly do-everything hoodie of business entities. An LLC is a state-level wrapper that can be taxed several ways. If you're alone, the default tax is a sole proprietorship. If there are 2 or more owners, the default is a partnership. Either way, profit usually passes through to your personal return. There's no separate entity-level income tax at the federal level, just your own. That sounds simple because it is. You take the net profit, you pay income tax, and if you're active, you also pay self-employment tax on most of that profit. Social Security and Medicare combined, the full 15.3% on the first chunk, and Medicare continuing above it. You don't have payroll by default. You don't issue yourself a W-2. You take draws, which are not deductible wages. The deduction happens inside your business before the draw. You don't have payroll by default. You don't issue yourself a W-2. You take draws, which are not deductible wages. The deduction happens inside your business before the draw. The LLC wins early because of flexibility. You can deduct ordinary and necessary expenses. You can adopt an accountable plan to reimburse yourself. You can take the home office if you qualify, and you might get the 20% qualified business income deduction if your income is within the limits and your trade or business qualifies. You won't spend evenings wrestling with payroll software just to pay yourself. The downside is that self-employment tax hits the whole active profit. At a few $1,000s of profit, that's fine. At 6 figures, it stings. That's the moment people start peeking at the door marked S-Corp. An S-Corporation isn't a type of company you file at the state. It's a tax election you make with the IRS. In practice, many founders form an LLC with the state and then elect to be taxed as an S-Corp when the time is right. The S-Corp is still a pass-through for income tax, but it changes the payroll math. You become both owner and employee. The company pays you a reasonable salary on a W-2 for the work you actually do. That salary is subject to payroll taxes like any other wage. Profit left over after that salary can be distributed to you as an owner draw that is not subject to Social Security and Medicare. The result, when done correctly, is that you pay employment tax on the part of income that looks like a job and avoid employment tax on the portion that looks like return on ownership. The phrase reasonable salary is where the grown-up rules live. If your S-Corp earns $150,000 after expenses because you personally sold, serviced, and delivered the work, a $20,000 salary and $130,000 distribution is fantasy. The IRS expects the salary to reflect market pay for your role, experience, and location. If a real company would pay someone $90,000 to do what you do, your S-Corp should be in that neighborhood. Underpay the wage, and you risk reclassification. The IRS can convert distributions into wages and add back payroll tax with penalties. Overpay the wage and you erase the very savings you came to find. Who actually wins with an S-Corp? Owners with stable, healthy profits above what a fair salary would be. Think a consultant who nets $200,000 and could justify an $110,000 salary, leaving $90,000 as potential distribution not subject to the 15.3% base employment tax. The savings can be material, even after you add back employer-side payroll tax on the salary, payroll provider fees, state unemployment contributions, and the time cost of running compliant payroll, filing quarterly payroll returns, issuing a W-2, and keeping minutes. But if your profit is thin or choppy, some months feast, some months famine, or your fair wage would consume nearly all the profit, the S-Corp doesn't move the needle and can even add friction. Many service pros adopt a simple rule of thumb. When consistent net profit comfortably clears a plausible market salary by, say, $20,000 or $30,000, run the numbers. If it doesn't, enjoy the LLC hoodie and keep building. There are also landmines that block the S-Corp path entirely. Owners must generally be U.S. persons, citizens or residents, and not certain trusts or entities. You can't have multiple classes of stock in a way that gives different economic rights. Certain states don't fully play along and may impose their own taxes or fees on S-Corps separate from personal tax. And once you elect S, you're in a new world that expects payroll discipline. If you hate admin, that's a cost too. Now open the third door and the air changes. The C-Corporation is its own taxpayer. It pays corporate income tax on its profit. When it distributes profit to shareholders as dividends, the shareholders pay tax again. This is the famous double tax. That sounds like a non-starter for small operators, and often it is. But the C-Corp exists for reasons that matter the moment you want investors, stock options, or a path to an outsized exit. Venture capital prefers C-Corp. Many stock-based plans and equity admin tools assume C-Corp. If you plan to raise, issue options broadly, or build a product company with real reinvestment needs, the C-Corp is the default. The C-Corp tax story isn't just double tax pain. There are bright stars in the C-Corp sky. One is the ability to retain after-tax profits inside the company to reinvest at the corporate rate without employment tax layers. If you plan to pour earnings into engineers, inventory, or R&D rather than paying them out, the corporate shell can be efficient. Another is the potential for Section 120 qualified small business stock. If you structure and operate correctly, original issuance, active trade or business, domestic C-Corp, gross assets test, 5-year holding period, some or all of the gain on sale of the stock can be excluded from federal tax up to large limits. For founders who aim for a big exit, 1202 can change the math of a lifetime. There are caveats and state mismatches, but the promise is real enough that sophisticated founders design for it on day one. Of course, the C-Corp has its own booby traps. Hoard too much profit with no credible business need and you invite the accumulated earnings tax. Own mostly passive assets, and you may wander into personal holding company territory. Pay personal expenses out of the company, and you don't look clever. You look like a case study. On the other hand, C-Corp can offer a richer menu of fringe benefits. Certain health, life, and education benefits can be deducted by the company without always counting as taxable income to owners in the same way they might in an S-Corp. The exact advantage depends on your facts, your state, and your appetite for paperwork. So how do you choose practically without turning your life into a spreadsheet? Imagine 3 snapshots. Snapshot 1. You're a solo consultant or creator. Profits under 6 figures while you build. Keep it simple. Form an LLC. Be taxed as a sole proprietor by default. Deduct what's real. Consider the QBI deduction if you qualify. Sweep a percentage into a tax bucket every time money lands. Sleep well. Snapshot 2. The business hums. Net profit is a steady $180,000. A fair salary for your role is around $110,000. Now the S-Corp becomes a tool, not a trophy. You elect S, put yourself on a real payroll, pay that reasonable wage, and let the remainder flow as distributions. You keep impeccable records for the wage analysis. You don't get greedy on the split. You enjoy the employment tax savings, and you pay for decent payroll support so you never file a quarterly return late. Snapshot 3. You're building a product, you plan to raise, or you care about stock options and a potential equity exit more than near-term distributions. The C-Corp is your native habitat. You live with the corporate return. You reinvest inside the company. You follow the rules for equity grants and vesting. You learn enough about 1202 to keep the option alive. You accept that dividends are rare and double tax is the cost of a bigger stage. There are crossover moments that deserve a spotlight. Converting an LLC to an S-Corp often means filing a tax election without changing the state entity. That's easy. Converting a C-Corp to an S-Corp can trigger a built-in gains tax for a window of years if appreciated assets are sold, and some states don't conform neatly. Converting a pass-through to a C-Corp for venture financing is common, but should be mapped carefully so basis, losses, and contracts don't get mangled. Late S-election relief exists if you missed a deadline but otherwise qualify. Mergers, investor demands, and multi-owner politics can change the answer you chose on day one. That's not failure, it's evolution. State taxes add their own flavors. California charges an annual franchise tax on corporations and a minimum fee on LLCs, plus a gross receipts fee once revenue rises. New York layers city taxes. Texas has a franchise tax that's more like a margin tax. Some states respect S-Corp status fully, others add their own levy. Delaware isn't a magic tax haven for operating companies selling into other states. It's a legal infrastructure play with friendly courts and predictable law. Nevada doesn't erase your home state's tax rules if you operate from, say, Los Angeles. The rule of thumb is boring and therefore right. You pay where you do business. Register where you operate. Foreign qualify where you have a real presence. Pick your state of formation for legal reasons and investor expectations. Not because a YouTube ad said it makes tax disappear. Compensation and benefits are where structures reveal character. In an LLC taxed as a partnership, owners aren't paid wages for their own work. Guaranteed payments can mimic a salary, but don't reduce self-employment tax exposure the way an S-Corp wage does. In an S-Corp, health insurance for more than 2% owners flows through payroll and is taxable to you, but often deductible by the company. The mechanics matter and the net effect can be fine if you do it right. In a C-Corp, certain benefits can be broader and cleaner. Retirement plans are available across structures, but a solo 401k in an S-Corp lets you pack away a lot if you pay yourself enough wage to support the deferral and match. A partnership can accomplish similar goals with different paperwork. None of this is about gaming. It's about matching benefits to the wrapper you actually live in. Losses and basis are the quiet actors. Pass-through losses can offset other income subject to basis, at-risk, and passive activity rules. If you funded your LLC with your own cash or loans you're personally on the hook for, those losses might be usable. If your basis is thin, because the business borrowed from a bank without your personal guarantee, or because you haven't contributed much capital, your losses may be suspended until basis grows. In an S-Corp, shareholder loans must be direct and real to build basis. In a C-Corp, losses live and die inside the corporation. You don't claim them on your personal return. When young businesses run at a loss, the pass-through can soften the blow, provided the rules permit it. When mature businesses run a profit, the S-Corp wage plus distribution trick can soften employment tax. When scaling businesses reinvest heavily and aim at equity value, the C-Corp keeps the scoreboard inside the walls until a real exit. If you need a single sentence to carry around for the next week, carry this. Start simple, switch when the numbers and goals demand it, and never let a structure outrun your facts. If you earn a modest, fluctuating income and hate admin, the LLC taxed as a sole proprietorship is enough. If your profit clearly exceeds a fair wage for your role, the S-Corp can trim employment tax without cheating. If you want to raise capital, grant options, or chase a stock sale and 1202, the C-Corp is the natural habitat. The LLC, S-Corp, and C-Corp aren't three moral choices. They're three toolboxes. Choose the one that matches your work, your wallet, and your ambition.